Russia's central bank released its interest rate decision today. Joining me now to discuss this is Dmity Dolgin from Alfa-Bank in Moscow. Dmitry, can you briefly outline what was said in the meeting today in Moscow, and was this outcome what was expected?
The headline interest rates were kept unchanged in line with our expectations and expectations of most of the market participants. But at the same time, there was a 25 basis point cut in secondary refinancing instruments. Like I said, the headline, the unchanged headline figures were pretty much expected because the rather negative inflation data which recently came out, namely the fact that annual inflation rates remained above the target 6% threshold. But at the same time, the poor economic growth in Russia, namely the deceleration to 1.2% year on year in the second quarter, created expectations on the markets that central banks should step in and support the economy. So as a result, the central bank seemed to have provided a half of solution by cutting the secondary rates.
Inflation is exceeding policymakers' goal for a year, even as the economy grows at its weakest pace since 2009. What's your overall view on why this is happening now, and what does this mean for the rest of the year?
It is true that over the last couple of years, the inflation in Russia was not driven by expansion of economic activity, but it was rather due to some negative developments on agricultural markets. That was due to various poor weather conditions globally and in Russia overall. And the second most important contributor to the Russian inflation was the growth in natural monopolies tariffs. So this year is not an exception. There were two negative developments in terms of local inflation. First of all, it was the flood in the Far East region of Russia, and the second negative development is some restrictions on imports from Russia's CIS trade partners. So altogether, that added up to higher than expected inflation, and now it is more or less obvious that this year inflation is unlikely to fall below the 6% target thresholds target by the central bank.
How did the decision to freeze utility prices in 2014 affect the chances of cuts to key policy rates?
Obviously, this decision changes dramatically the inflationary outlook for the next year. While initially, for example, we expected inflation to accelerate even to the level of close to 7% year on year next year, now it is more likely that inflation will decelerate to around 5.5% by the end of next year. However, it is not yet clear whether the central bank can use this deceleration as a window of opportunity to cut the interest rates. First of all, it is not. The inflationary risk still remain because the cut in tariffs strongly affects the capex programs by the state monopolies, and as a result, they might lobby for additional financing from the National Welfare Fund, so sort of increase in off-budget spending by the government. So that may actually add up to additional inflationary pressure next year. And secondly, while inflationary argument clearly is somewhat losing importance, the capital outflow considerations also need to be considered. The capital outflow risks due to global flight from risk and Russia's internal structural weaknesses remain significant, and that means that there is some possibility of central bank rate cuts in probably second quarter of next year. This scenario is still at risk, and even for the long term, the status quo scenario is very possible.
Dmitry, thanks for that, and thanks for joining me today. And that's all we have time for now, but do check back later for more from the team. Bye for now.